Welcome back to our Beginner's Options Trading class. This is part 5 of our series, and today we're going to delve even deeper into advanced topics and complex options trading strategies. Over the past 4 parts, we've built a foundation, exploring the basics, discussing various strategies, understanding options Greeks, and recognizing the role of volatility. If you've missed out on any of those, be sure to catch up. Now, if you're ready to enhance your options trading knowledge, let's dive right in. Let's start with a more advanced strategy, the iron butterfly. This strategy is a fascinating blend of 2 strategies we've previously touched on, the iron condor and the butterfly spread. It's like a culinary fusion, blending the best of both worlds to create something unique and exciting. In the world of options trading, an iron butterfly is a strategy that involves selling an out-of-the-money call and put, while simultaneously buying further out-of-the-money calls and puts. Picture it as a balancing act, where you're trying to maintain equilibrium amidst the unpredictable movements of the market. This strategy is not for the thrill seekers. It's a neutral strategy, best employed when you anticipate low volatility in the market. It's like choosing to sail your boat on a calm day, rather than braving the stormy seas. Remember, understanding these strategies is like mastering the art of chess. It takes practice and patience. So take your time, digest this information, and let's get ready to dive deeper into the world of options trading. It's a neutral strategy used when you expect low volatility. Ratio spreads are more complex but provide additional flexibility. This strategy is a variation of the basic spread strategy, but with a twist. Instead of buying and selling equal amounts of options, you play with different quantities. Let's break it down. A ratio spread involves selling and buying options in different quantities. For instance, you may sell 2 call options for every 1 call option you buy, or vice versa. This is where the term ratio comes from. Why would you want to do this? Well, it can help manage risk and potentially boost profits. The ratio spread strategy can be used when you have a directional bias on the underlying asset, but also want some downside protection. Remember, the ratio spread is not a set it and forget it type of strategy. It requires active management and a solid understanding of options pricing. But with practice, it can become a powerful tool in your trading toolbox. This strategy offers both limited risk and unlimited profit potential. Advanced risk management is critical in complex options trading strategies. It's like the safety net that ensures you don't fall too hard when the market isn't on your side. Now, let's take a closer look at some of these techniques. Firstly, we have stop-loss orders. Think of them as your personal bodyguard in the market. These are preset prices at which you're willing to exit a trade to limit losses. If the market starts to go south, your stop-loss order steps in and says, "That's it, we're out." Next, we have hedging. Essentially, it's the investment world's version of an insurance policy. Hedging involves using options to protect your investments from unfavorable price movements. It's like carrying an umbrella when there's a chance of rain. Lastly, we have position sizing. This is all about determining the number of contracts or shares to trade to manage risk effectively. It's like choosing the right-sized life vest before jumping into the deep end of the pool. Remember, too big or too small, and you're in for a rough swim. Before implementing complex strategies, it's essential to backtest and practice using paper trading. Backtesting is a quintessential step in options trading. It involves evaluating a strategy's performance using historical data to see how it would have fared. Think of it as a time machine, giving you a glimpse into the past to understand how your strategy might perform in the future. It's a valuable tool that can help you refine your strategies before staking real money. Now, let's talk about paper trading. It's like a dress rehearsal for a play, a chance to practice your moves before the actual performance. Paper trading allows you to simulate trades without any real money at stake. It's a fantastic way to practice your strategies, analyze outcomes, and make adjustments in a risk-free environment. It's like testing the waters before diving in. Remember, practice makes perfect, and paper trading is a risk-free way to practice trading without using real money. Let's explore real-life scenarios to see how these complex strategies and advanced risk management techniques can be applied to different market conditions. Imagine you're studying a stock chart, and you notice the price is relatively stable. This could be an opportune time to employ the iron butterfly strategy, given the low volatility. Now, envision a different scenario where the market is fluctuating wildly. Here, a ratio spread strategy might be more suitable, providing you with the flexibility to adjust according to the market swings. In another instance, suppose you've entered a risky trade. You've set a stop-loss order to manage potential losses, hedged your position to protect against unfavorable price movements, and used position sizing to limit your risk exposure. And remember, before diving into real trades, use backtesting and paper trading. These tools allow you to test your strategies against historical data and in a risk-free environment, respectively. These scenarios will give you a better understanding of how to apply these strategies and manage risk effectively in your trading. That's a wrap for Part 5 of our Beginner's Options Trading class. We've navigated the intricate paths of advanced strategies like the iron butterfly and ratio spreads. We've also delved into the importance of advanced risk management and the practicality of backtesting and paper trading. As we continue on this journey, Part 6 promises to delve deeper into advanced concepts, trade adjustments, and real-time market analysis. Until then, keep learning and keep trading.